All right. Choose your own transactions, accounting practice. This is just doing accounting in just a little different way than we've done it before, where you guys are actually going to write down the transactions. You guys come up with the transactions over in this tab right here. So I'll tell you what I would like you to do, how I'd like you to affect the columns, and you write the transaction, and then you'll come over here and you will record it. So you can write all the transactions and then do all the recording, or you can just do one by one, whatever you do. I will probably do all 10 and then come over and do the accounting for that. So here we go. Starting out, increase cash, increase owner's equity. One way to do that is to have the owner of the business, we'll say Ella, deposits I would have to spell business correctly. All right, so Ella puts $50,000 into the business. Again, to show you guys how to do it, I shouldn't say again, for the first time, we received cash as the business, and it would affect owner's equity, right? It should be pretty easy to record this side because I have told you what accounts that I would like you to affect with this right here. Okay, next one, increase inventory, decrease cash. So the business purchased, let's say, $20,000 worth of inventory and paid with cash. Boom, right? Very easy. We lost $20,000 cash. What did we gain? $20,000 inventory. We just traded one asset for another. And again, I've already told you what we're trying to do. Increase inventory, decrease cash. So it should be pretty easy from that standpoint. Make sure, I misspelled business again. My left hand must not be working very well on the keyboard. Okay, here we go. Next one, increase equipment, increase accounts payable. So we are buying equipment, but we're not paying cash for it. So we are going to borrow money. This is going to be a liability. So it's going to be similar to the one before. The business purchased, let's say, $10,000 worth of equipment, and we pay for it on account because that is a credit transaction. We owe that at a later date. So $10,000 for equipment, boom, that's what we gained, and we borrowed that amount. So that is accounts payable. 10,000 minus 10,000 equals 0 for owner's equity. Nothing for receivable, nothing for inventory, nothing for cash. All right, here we go. We keep cruising here. On to number 4, increase cash, decrease inventory, increase owner's equity. So here's what's happening. We're selling some of our inventory. That's how we lose the inventory. We are receiving cash from a customer, and there's going to be profit involved there too. So we have to go back and look at how much inventory we have. We have $20,000 worth of inventory. If we want to sell all of that, let's see, the business sold $20,000 worth of inventory to our customer for $35,000. That's a pretty good markup right there. So let's see how we record that. What did we gain? Oh, I should say how they paid, right? $35,000 cash. I need to know if that's cash. I need to know if it's check. I need to know if it's on account. That would affect accounts receivable instead of cash. But we received cash, $35,000. We lost inventory of $20,000. Right? 35 minus 20 is 15. We have no debts. We're not taking on debt, paying down debt. This is profit from revenue. $15,000. Yeah. We're the owner. We can write ourselves a bonus check. All right, on to number 5. We're doing all right on time. Number 5, decrease cash, decrease accounts payable. So if we decrease cash, decrease accounts payable, we're going to pay off some of our debt. So if we go look at our debt's $10,000. Let's pay $5,000 of that accounts payable off. Okay? Actually, you know what? Let's pay all of it off. All right? The business wrote a check to our creditor for $10,000 to pay off our equipment. Wow, my spelling is terrible today. Our equipment purchased in number 3. Okay, so that decreases cash, decrease accounts payable. We can do that. We are minus 10,000 cash, and we're paying down our debt. So our debt is back to 0. We don't owe anybody money. That does not affect owner's equity. Minus 10,000 minus a negative number, that turns into a plus. Negative 10,000 plus 10,000 equals 0. We're balanced, we're moving. Here we go, number 6. Decrease cash, decrease owner's equity. One very easy way to do that is to pay an expense, right? Expenses are always minus 0 minus. Paid the monthly rent of $2,000 by check. This is a, what did I do here? Excuse me, here we go. This would be known as a rent expense. Boom, $2,000 by check, minus 2,000. Minus 2,000, right? Expenses are always minus 0 minus. These are not debts. These are costs of operating our business. Number 7, decrease cash, increase equipment, increase accounts payable. So we're going to increase equipment. That means we're going to buy equipment. We're going to pay part of it in cash, and we're going to borrow the rest. So the business buys, let's say, $5,000 worth of equipment and pays $4,000 cash and the balance on account. We're pretty good at math, so we can say that is $4,000 cash and $1,000 on account. So we gain $5,000 worth of equipment, increase equipment, pay $4,000 cash, decrease cash, and pay the balance on account. That's going to increase accounts payable by $1,000. So we gained equipment, we lost cash, and we borrowed the rest. And we will solve for capital. So 5,000 minus 4,000 is 1,000, minus 1,000 equals 0. And we're moving on to number 8. Crushing this thing. Here we go. Transactions. I'm going to stop doing the accounting on the other side. I feel like that's very self-explanatory. I think you can do that for 8, 9, and 10, but I will finish writing these transactions. So again, you can write your own transactions. These should be just to check the work that you are doing. Increase inventory, increase accounts payable. You are going to buy inventory and you're going to pay for it on account. So make sure you have a value associated with it to increase inventory and increase accounts payable. We buy inventory. That's what our business gained. We didn't lose anything. We paid for it on account. We used our credit card. We promised to pay at a later time. Number 9, decreasing inventory, increasing accounts receivable, increasing owner's equity. All right, so we're selling our inventory. Our customer is going to pay us on account. That's our accounts receivable. Accounts receivable is an asset, so that's going to increase accounts receivable. They should be paying, if we're operating a profitable business, they should be paying us more than the amount that we paid for our inventory. So that profit should go into owner's equity. So you should have profit, you should lose some inventory, and you should receive some payment on account. So you're going to receive it at a later date because we've already sold these products in this instance since we have an inventory for it. Number 10, decrease accounts receivable, increase cash. So for example, from number 9 where we increased accounts receivable, now this customer is going to pay us cash or check, and it's going to increase our cash because that's what we receive, and it's going to decrease our accounts receivable because we are owed less money. The other company is paying down their accounts payable. We are going to reduce our accounts receivable because we are owed less money later. So again, you guys come up with the amounts for that. You could receive check or cash. Cash is check for these examples. And that's number 10. You can make sure after you've done the last 3, 8, 9, and 10, I can tell you we're all balanced through 7. Again, it needs to be balanced for each line across. So 8 this way, 9 this way, 10 this way. And then if you want to total them just to make sure everything is good at the bottom, you can go through and you can add them up. You can use that auto sum button. Oops, I did that in the wrong column. You can use that auto sum button, and you can figure it out that way. It's pretty easy. We did that during the budget unit. All right. Okay. Good luck. Holler if you have any questions.